Instructor continues the lesson. Now, let's move on to the next topic, hazards. Hazards are conditions that increase the likelihood of a loss. The first type of hazard is physical. Physical hazards are tangible factors that can contribute to a loss. Instructor provides an example. Imagine you have a set of tires with very little tread. These worn tires increase the risk of an accident. The slick tires are a physical hazard because they extend your stopping distance, especially on wet roads. If it's raining and you have worn tires, there's a higher chance of a loss caused by the peril of an accident. The accident itself is the peril, while the loss is the reduction in your car's value and potential out-of-pocket expenses.
So by replacing worn tires with new ones, you can reduce the risk of an accident and manage the physical hazard?
Exactly, Pearl. That's a great example of risk management through risk reduction. You could also transfer the risk to your insurance company by purchasing auto insurance. While you could theoretically avoid the risk altogether by not driving, that's not practical for most people. Instructor moves on to the next type of hazard. The second type of hazard is moral hazard. This refers to the risk of people being dishonest on their insurance applications. For example, a client might lie about their tobacco use to get a lower life insurance premium. Tobacco users typically have shorter life expectancies, so insurers charge them higher premiums to compensate for the increased risk. If a client lies about their tobacco use, the insurer will collect lower premiums than they should based on the actual risk.
So, if the person dies sooner than expected because they actually were a smoker, the insurance company loses money.
Precisely, Don. The insurer didn't collect enough premiums to cover the risk because of the client's dishonesty. Moral hazard can also occur when clients exaggerate or falsify claims to receive larger payouts. Instructor introduces the next hazard. The third type of hazard is moral hazard. This occurs when an insured person lacks the motivation to minimize losses. Imagine someone with disability insurance who suffers a minor injury and realizes they can make nearly as much money staying home as they can by working. They might be tempted to extend their recovery time unnecessarily, leading to larger claims for the insurer.
I see how that lack of motivation to return to work could be costly for the insurance company.
That's right, Pearl. Moral hazard is a significant concern for insurers, particularly with disability and workers' compensation policies. Instructor moves on to the final hazard. The last type of hazard we'll discuss is legal hazard. This refers to the risk posed by our litigious society. people are more likely to sue over minor issues than ever before, which can be costly for insurers. To avoid lengthy and expensive legal battles, some insurers may settle claims quickly, even if they believe the claim is fraudulent.
So, the increased likelihood of lawsuits is a hazard for insurance companies.
Yes, Don? Legal hazard is a condition that increases the probability of a loss for insurers. Remember, a loss is defined as a reduction in the value of an asset, and legal costs can quickly eat into an insurer's assets. Instructor pauses for questions. Any questions about the 4 types of hazards we've covered? The class is silent, indicating understanding. Great! Great job on completing this video. Now it's time to test your comprehension of the concepts we just discussed. This video corresponds to ICAP quiz course number 8. Remember that number. Click the link in the comments section to access the Insurance Class Assistance Program, also known as ICAP. Once you're there, look for quiz course number 8. This quiz will help us see if you truly understand the material and are prepared to move on to the next video. Don't forget, ICAP quiz course number 8. Good luck and keep up the great work.